When you're earning $1 million or more, real estate isn't just about appreciation. It's about timing your depreciation. Under the Big Beautiful Tax Bill, or TLB3, cost segregation has become one of the most powerful and completely legal ways for top earners to front-load deductions, free up cash flow, and redirect tax savings into more income-generating assets. Now, if you are new here, welcome to the $1 million Plus series. This is video number 14, and we are talking about cost segregation, especially for luxury properties. We are going to break this video into 6 clear parts, and I will walk you through each step one by one. So, by the end, you will know 1. What changed under TLB3 and why timing matters more than ever. 2. How real high-income clients are using cost segregation to save 6 figures. 3. The exact step-by-step process to use this in tax year 2025 to do this the right way. 4. How to plan ahead for 2026 and beyond. 5. The hidden luxury-specific opportunities that most high earners miss. 6. And finally, how to take action so depreciation becomes your wealth engine, not just an accounting line. Let's dive in. So part 1, what changed under TLB3? So let's talk about what really changed. Before TLB3, the rules were tightening. So bonus depreciation was scheduled to drop from 80% in 23, 60%, 40%, and then 20% by 2026. High-income investor was watching their ability to accelerate deductions slowly disappear. But TLB3 changed everything. Congress restored 100% bonus depreciation for qualifying properties acquired and placed in service after January 19, 2025. That means if you act in time, you can still write off the entire cost of qualifying component in the first year. And here another key addition. TLB3 introduced Section 168N, a new election for 100% expensing of qualified production property. Now, this doesn't apply to all buildings, but it signals that the government continues to favor front-loaded deductions for high-producing activity. At the same time, the IRS reaffirmed that short-term rental and mixed-use properties can qualify for depreciation and cost segregation as long as they are held for income or business use. That's a big deal for high-income owners who use real estate strategically, like short-term rental operators, business owners, and professional investors. And one more important point before we move to part 2, for audit protection, a professional engineer-based cost segregation study is still the gold standard. It's not optional if you want to defend your position confidently. So remember this takeaway in part 1. TLB3 reopened the door to 100% bonus depreciation, but only for those who understand the timing, the structure, and documentations. Let's make it real. Let's move to part 2. Now that you know what changed, because understanding cost segregation in theory is one thing, seeing how it transforms someone's actual tax outcome is another. Let me introduce you to Mark, one of our clients based in Palo Alto, California. Mark is a 43 years old tech executive earning about 1.8 million AGI. In early 2025, he purchased a 2.4 million coastal duplex in Santa Cruz that he operates as short-term rental. Here's where it gets interesting. Mark doesn't just rent it out passively. He manages the listing himself, oversees cleaners, handles pricing, and provides concierge-style guest experience. That means he qualifies as materially participating under IRS rules. When we met, Mark thought depreciation would be something that just happened slowly over 27.5 years, barely enough to offset his rental income. but we order a professional cost segregation study right after closing in March 2025. Here's what the engineer found. Roughly 28% of the property, about 672,000, could be reclassified into shorter assets life, so meaning the 5, 7, and 15-year property. Because it was placed in service after TLB3 took effect, 100% of that amount qualified for bonus depreciation. That gave Mark an immediately $672,000 deduction in his 2025 tax year, cutting his federal tax bill by nearly $200K. And he reinvested that savings to furnish a second rental property, doubling his income base within a year. So if you are watching this and thinking, that's great, but how do I actually do that myself? Don't worry, that's exactly what we will cover in part 3. From example to action. Now, we have seen what's possible. Let's slow it down and get practical. In this next section, we will walk step by step through how high-income earners like you can use cost segregation in 2025 safely, strategically, and with real results. Let's call this your 2025 cost segregation game plan. There are 6 steps that can help you save hundreds of thousands legally and responsibly. Step 1. Start with a professional study. Hire an engineer-led firm early, ideally before year-end. They will break down your property's components and assign each one a tax life based on construction cost data and IRS guidelines. Step 2. Coordinate with your CPA. Make sure your CPA knows when the property will be placed in service. The date matters. Only property placed in service after January 19, 2025 qualify for the restored 100% bonus depreciation. Step 3. Use Form 3115 to retroactively studies. If you have owned property for years but never did a study, it's not too late. File Form 3115 to make a Section 481A adjustment, which lets you catch up missed depreciation in the current year without amending old returns. Step 4. Qualify for non-passive treatment. This is where high earners often miss out. To actually use the deduction against W-2 or business income, your rental activity must be non-passive. You can qualify either as a real estate professional rep with 750 plus hours and more than half of your work in real estate, or as a short-term rental operator with an average guest stay under 7 days and active participation. Step 5. Keep meticulous records. Maintain the engineer's report, invoices, floor plan, and photos. The IRS Cost Segregation Audit Technique Guide say the quality of documentation is often what separates an allowed deduction from a disallowed one. Step 6. Stack with other TLB3 incentives. Combine cost segregation with Section 179 expensing, qualify improvement property deduction, and the newly restored 100% bonus depreciation. Layering them can maximize your front-end tax leverage. By the end of this process, you are not just accelerating deductions, you are reshaping how each cash moves through your portfolio. Let's move on to the next stage of thinking. That's before we cover how to use cost segregation today. But what happens when bonus depreciation inevitably shifts again? So let's talk about how the smart money plan for the next cycle. Let's move on to part 4, which is planning beyond 2026. Even though TLB3 revised 100% bonus depreciation, long-term investors know the landscape always changes. The real question isn't if the rule tighten again, it's when. Here's how to think 2 steps ahead. 1. Time your renovations. If you are planning remodels, upgrades, or energy efficient improvements, complete them before the next legislative phase down. Improvements like pools, driveways, and solar systems often qualify for a 15-year life, perfectly for cost segregation and bonus depreciation. 2. Use partial asset dispositions. When you replace property components, say HVAC or roof, use Section 1.163I-8 to deduct the remaining basis of the retired assets right away. That's an immediate write-off most investor miss. 3. Refinance strategically. After reclaiming big depreciation deduction, your property's taxable income drops, but your cash flow doesn't. Refinance to pull out equity and use that cash to buy another property. That new assets restart the depreciation cycle, a loop that builds wealth faster. 4. Plan for recapture early. Depreciation recapture isn't something to fear, it's something to manage, like 1031 exchange to defer it, or consider a charitable remainder trust, or legacy giving is part of your plan. Here is your mindset for part 4. Tax law will keep changing, but if you understand the rules, you can move ahead of them. Now that you understand the general mechanics, let's focus on what this looks like in the luxury property world. Because high-end real estate doesn't just create beauty, it's high opportunities. Let's move on to part 4, which is luxury specific opportunities. Luxury properties are built with details, and details are what make cost segregation powerful. Let's look at where high-income investors are finding the biggest win under TLB3. High-end short-term rentals with pool, patios, saunas, and landscaping often qualify for 15-year life. Furnishing and decor, typically 5 to 7 years property. Smart home technologies like automatic lighting, integrated sound system, and security setup are usually 5-year properties. Designer finishes and outdoor features like fencing, irrigation, and paver. 15-year assets that can all be fully deducted under TLB3. Mixed-use spaces. If you own a property that part personal, part business, say a condo with a commercial suite, you can segregate and depreciate the business portion separately. Converted estate property. When a personal home is converted to rental use, depreciation starts at the lower of cost of fair market value. From there, a cost segregation study can identify the 5, 7, or 15-year component to accelerate the new depreciation schedule. Here's a quick example. Sophia, a physician from Miami, converted her $3.2 million vacation villa into a short-term rental in early 2025. A cost segregation study identified over $800,000 assets eligible for immediate deduction. Her after-tax savings funded a down payment for another investment home in Naples. Luxury real estate, when structured right, isn't just indulgent, it's infrastructure for wealth. So now we have covered a lot. Let's zoom out for a moment. If you have made it this far, you now understand the power of cost segregation and how TLB3 have given high-income investors a second chance to use it wisely. Let's close with the big picture. The big beautiful tax bill gave high-income owners a revived opportunity, but it won't last forever. You have a temporary window to use 100% bonus depreciation for properties placed in service after January 19, 2025. If your AGI is about 1 million and you own or plan to buy income-producing real estate, the biggest mistake you can make is waiting. Every month you delay is another month you could have been compounding your savings through tax efficiency. Depreciation isn't just an accounting entry, it's a timing weapon. It's the lever that lets you redirect taxes into wealth building investments. So here's your takeaway. Study it, learn which assets qualify, elect it, make the proper election on your return, execute it with a professional study and a solid plan. That how $1 million on your turn luxury assets into breathing tax shelter under TLB3, and why 25 and 26 are the most important years to act. Because the wealthy don't wait 27 years for deductions. They take them now and let time work for them. Thank you for watching. I'm Mira and I will see you in our next video update.